got Lawrence Hartman, Larry, and we've got Bobby, Krishna, and Divakar all joining us, excuse me, for the panel discussion today. Let me get them on the screen and spotlight them. So, where are you guys? Krishna, yes, I can see you. I've spotlighted you. I
Hi,
can see
Hemant.
Divakar, adding you to the spotlight. Where are you, Larry?
I
Yes,
see you.
I have to find you in a sea of people. Yes, and Krishna is here. Divakar, who am I missing? Bobby.
Hi, Hemant. Hi, all. Can you see me and hear me?
I can. Are you not joined by your name?
I think it's just come up with the initial
Okay, I see you. You joined as
BCBCV.
BCV. Okay, fantastic, fantastic. So I
It's
just need to
code.
do a quick introduction of yes, okay. So I'll quickly introduce Larry and then he can introduce the rest of you. Larry Lawrence is the Chief Strategy Officer at ninjascan.ai, where he is driving a mission to make web accessibility both meaningful and truly effective. At a time when many solutions rely on only surface level overlays, Larry and his team are taking a fundamentally different approach, scanning source code to identify and resolve accessibility challenges at their roots. Through this, ninjascan.ai enables businesses to meet global standards such as the European Accessibility Act while also enhancing SEO, sustainability, and overall user experience. Larry is a strong advocate for ethical performance based compliance, believing that accessibility should empower users rather than rely on temporary fixes. His work sits on the intersection of technology, inclusion, and digital strategy, helping organizations build more accessible, high performing, and future ready digital platforms. Larry, over to you. The panel is yours.
Thank you very much. And it's I feel very honored. Here we are on day 8. It's been a very exciting conference so far. Learned a lot along the way. A lot of engaging conversations. So I have the honor of presenting our other 3 panelists. We have Bobby. He's the founder and CEO of One FS Wealth, a leading fintech company. As an experienced investor, he has advised many companies and has sat on the board, advisory board, a board of investment committees of a number of funds and companies. He has extensive experience in managing funds in multiple jurisdictions, including Luxembourg, Mauritius, Bermuda, and sub Saharan Africa, and consequently has an extensive international network at institutional, family office, and HNWI level, and a proven track record in turning around funds and companies. So, thank you for joining us today, Bobby. Next, we have Divakar. Divakar is a force in the world of investing, strategy, and corporate transformation. With 25 plus years of high impact experience across technology, strategy consulting, and investment management, he has consistently delivered market beating returns for investors while driving breakout growth and value creating M&A at the CXO and board level. He's a capital markets and macroeconomics expert. He brings rare global depth across cyclical industries and diverse asset classes. He is equally passionate about behavioral finance, asset management, and the powerful interplay of politics, society, and economics. He doesn't just analyze the world, he helps shape it. Lastly, we have Krishna, who is an investment and M&A professional with over 23 years of experience across private equity, investment banking, and corporate transactions in the GCC, MENA, and international markets. Over the course of his career, he has advised and structured more than 100 transactions with an aggregate value exceeding $28 billion across sectors including food, beverage, oil and gas, financial services, education, healthcare, retail, construction, and technology. Krishna currently serves as the Chief Investment Officer at Gutman Capital, leading the principal investment team and advancing their investment banking advisory offering for external clients. Previously, he served as the executive director, investment and M&A at Woosum Holding, where he held the evaluation and structuring of strategic investments and acquisitions. Prior to that, he spent 16 years as managing director at Alpine Capital, advising corporates, family offices, and institutional investors on cross-border M&A, capital raising, and strategic transactions across the Middle East, South Asia, and Africa. In his early career, Krishna held roles at KPMG in transaction advisory and audit. He is a chartered accountant and has completed the general management program at the Indian Institute of Management, Ahmedabad. Krishna is also an active commentator on investment trends and M&A in the Gulf region. Krishna is an avid reader, a sports enthusiast, and enjoys classical music and travel. So now that we're done with the introductions, let's get set up with the key takeaways. I mean, here we are. We're talking about multi-asset portfolio thinking. We've described, as Hemant mentioned, a number of asset classes. And as we all know, it's kind of a fool's errand and very risky to keep all your eggs in one basket. So let's start off with the concept of what is the core philosophy that each of you use that drive your asset allocation, and how has it been tested in the recent years? So I'll start with you, Divakar, if that's okay.
Thanks, Larry. My sort of 2 cents on that is nothing much has changed in terms of the multi-asset strategy. It's still the same. It depends on what investors want in terms of their liquidity. The usual 70-30 split between public markets, private markets still works, but probably what's changing right now is the tenure for which you would hold these assets, the amount of volatility you're seeing in some of these assets. Now with private credit markets, themes like AI and cryptocurrencies and all those things. So I mean that's how I see it. Maybe the tenure has shortened, volatility has increased, but the structure predominantly remains the same depending on investors' liquidity requirements.
Yeah, that's a very good insight. Thank you very much. And Krishna, what are your thoughts and how are you approaching this?
So, hi everyone. So we are unlike most asset managers. Our philosophy is one of an operator, owner-operator. So when we look at allocating capital, we're not thinking in terms of fund cycles or benchmark relative terms. We are the investment arm of an industrial group that builds and operates real businesses. We are into building materials. We're into hospitality. So when we are thinking of asset allocation, we're really thinking about what does the asset actually produce, what could go wrong with it, how does it have an alignment with our portfolio, and so on and so forth. And over the last 2 years, I mean, actually over the last 15 years, since the group has been operating in the GCC and across Levant and North America regions, we've only seen growth. The last 2 years have been no different. One, obviously, we are very well benchmarked with the real estate and construction industry because we come in at the fag end. But all of the companies that we've invested in have seen that growth, and that we've seen pretty much steep post-COVID.
Thank you very much. And Bobby, what are your core philosophies in this area?
Yeah, I think it comes back to really one saying I really like is you can't see the wood for the trees. And it's a really powerful saying because I think a lot of people actually get down in the weeds and they think, right, okay, so this is how we're going to think about our portfolio construction. And then they're not looking at the macro trends. And I think that the rotation for me over the past few years has been analyzing macro trends and then really off the back of that, equating that back to risk factors and correlation. Because if you look at what's happened during markets when there have been extreme events, then correlations go to 1 usually. And that happened back in GFC, that happened in 22. Bonds and equities both came off in line. And if you think about what's happening right now with the war, with the wars plural actually, and if you're thinking about what's happened with gold as a commodity, and gold's always been a difficult one anyway to trade or even to get a handle on, it comes back to what are the macro factor pushes been. So I think that it's easy to say, right, okay, I have a diversified portfolio. But actually, a lot of people don't. What they do is they just have a bunch of tickers which are different. And I'd say that's actually what you need to be wary of. And that comes back to my first point, that we can't see the wood for the trees. I always try and apply that to everything I think about, because that also applies to running a business and being an operator as well. So yeah, that's my answer.
No, thank you very much. I mean, that's a very good point. Part of reallocation doesn't have to do with just, let's say, taking down some of your outperforming positions and reallocating those funds, but it also has to do with paying attention to what's going out there in the markets, including the need to be flexible for unforeseen circumstances, like the wars, for example. And Bobby, I'll stick with you for this. So,
Sure.
what do you think about the balance between private and public markets today? And I think that, it's an interesting point to be made that fewer and fewer companies are going public, particularly in the US, making it so you probably have to consider more private investments nowadays. But what are your thoughts on that?
I think it's the same as anything you do in life. And sorry, that sounds a bit philosophical, but it comes down to understanding what you're allocating to. And what we've seen from practical experience terms is that a lot of people think that actually allocating to private markets is easy, in quotes, but also it's the same understanding and logic one applies to as to public markets. And that's not the case, and it's not the case at all. And I think people have come unstuck. And when I say people, that includes multi-family offices, single-family offices, not just high net worths, although there's been that rotation into private market assets and the commoditization of private assets for high net worth individuals. But so it comes back to the understanding, and I think it's always useful to give exact examples. And I think that two examples are what's happened recently with private credit. Everyone thought private credit was an easy trade, and it was for a number of years. And then now what's happened, you've got the big funds gating, and there's been a lot of PR about it. It started last year, actually, and it wasn't just a case of starting this year, and it's getting worse. And what's that overall risk? Well, I think that's still to be assessed. But the simple allocation of private credit has left some people actually coming stuck in terms of being able to draw capital out. They thought that they could easily redeem, and they can't. It's been gated. The other example is actually around private market allocation. We work with a lot of family offices, and we indeed have allocated as a family to private market assets. And where you get into directs and then you get into complex structures, what people tend to forget is that, okay, so you might be looking at a multiplier of 5 to 10x or whatever, it could be much greater. But then tax adjusted, what is that? What is that? The return. So I think there are other risk factors, which is what I meant before, and I came back to. People don't think about the overall optimization of structures, and I think that's really just one of the components that you've got to factor in. Whereas actually it's very easy to allocate to public market assets. There's no friction. And if you going for a beta approach through ETFs, then clearly that's easy. You just allocate to a ticker. But also if you allocate to funds, it's straightforward. Everyone else is taking care of the hassle. You don't have to deal with any of that. So I think there are pros and cons, and I think that it's easy to get seduced into thinking, oh, the holy grail is private market assets.
Yeah. No, thank you very much. There's a lot of food for thought in that, and really appreciate that. Especially, the concept of a trade works until it doesn't, right? When it comes to the private capital markets and the like. So, and Divakar, what are your thoughts between private and public markets today? How are you investing, and how are you guiding investment and giving advice?
Yeah, I think this question is a bit tough to answer. So in hindsight, if you look at it, the split between public and private, private assets really did well, let's say 15 years ago, before the GFC. But ever since MMT, right, starting with Ben Bernanke and the growth of passive investment, public markets seem to have outperformed public markets, right? So that's sort of in hindsight. However, in certain industries, private assets have done well. In sort of the traditional industries where there's a leveraged buyout or activist sort of involvement of the private equity funds, they seem to have done well. But I would say there's no way to predict. In hindsight, maybe a 50-50 allocation would have done well. Now, what's going to happen going forward? There is a change. There is a regime change that's happening. For example, you're seeing a lot of cutbacks in public spending in the US. The new Fed chairman is strictly against MMT in some way or the other. That's what he's conveying, saying that the Fed is going to be out of the market, right? So maybe it's going to change. Maybe active management and private markets will make a comeback. So I would still sort of put it as 50-50, but with close monitoring and keeping your eye on the IRRs on a strict basis. That's how I see it.
Yeah, no, very, very good points, especially with regards to government involvement in the financial markets. I was always, I was never a big fan of qualitative easing, for example, because here you got the right hand of the government issuing debt, the left hand of the government buying it to go and manipulate interest rates, and everybody drinking the Kool-Aid and buying into this nonsense. So I completely get it. And so, Krishna, why don't we go to you with that? What do you see in the sort of balance between private and public markets, and what do you think shifting that balance?
Yeah, well, for us, I mean, when we think of balance, it's not like a ratio that we need to achieve or work towards. The question that we look at is really of risk and reward. So basically, what am I giving up, and how am I being adequately compensated for it? And I think Divakar, I think, touched upon it in terms of public and private markets, and I fully agree with that. For a long period of time, private markets offered quite a bit of a premium over public for complexity, for illiquidity, and for the work involved. But I think that premium has compressed significantly. There are transactions that we've seen in private equity today where one is playing public market multiples but accepting private market liquidity or illiquidity, so to speak. And I think that's not a great deal, however way it is structured. I think Bobby mentioned about private credit, but I think in this region, I am seeing private credit really taking up their place here. I think it's one of the late entrants, so to speak, in that. There are higher returns, there's a longer holding period. And I think it's among the more compelling risk-adjusted opportunities that I'm seeing today. Having said that, we are now witnessing private markets gaining more traction. Valuations are sort of getting more thinner, more realistic, really. And I think there is that level of premium still to be achieved over a period of time, especially given what's happening within this region. I think that is a clear trend that we are seeing, and that's what we are also very actively looking at when we look at M&A and when we look at asset allocation. And then, of course, for us, there's co-investment as a strategy where you have sort of operating knowledge than a pure financial sponsor, and because we are an operator investor mindset group, that's what we bring on the table. We can sit alongside a business, we can sit alongside entrepreneurs, and actually help them run it better based on the ecosystem that we bring on the table.
Yeah, no, thank you very much. And I think they're all great answers. And it's very interesting. There's such a blur nowadays between private and public, also with these crowdfunding sources that are out there. And, they're raising money sort of in a public fashion. But by the same token, there's still private companies in many respects. You can't go and trade them on a public marketplace. And it really brings us toward the next question is, in the world where the access to the best deals, it really can make a big difference. How are you solving for deal sourcing? And Krishna, we'll go to you. And I just want to give one more thought. The other day, I was at an event in Miami. It was down at someone's house. It was amazing, and it was for a company called Going Public. Very interesting concept. Supposedly, it's going to be on Netflix in the near future. And it was a Shark Tank type of setting or type of format, but also at the end, allowing investors to actually participate in the investment in that company. So here we are, we're talking about this question where access, again, to the best deals is everything. How are you solving for deal sourcing, Krishna?
Sure. In my experience, I've witnessed deal sourcing to follow the same pattern. Sellers, advisors have access to buyers, or they have access to them or get access to them through their networks. And networking is clearly important to have first-hand knowledge of what's happening in the market. But I think what helps us get deals is really having demonstrated deal expertise and having those credentials that help us move from networking into sort of real origination. And we bring in close to about 3 decades of deal making experience, which our clients, funders, and other market participants are very well aware of. So that really gives us that edge. I think what is also unique to our value proposition is that we are a counterparty that brings in operational expertise, and therefore, we bring sector knowledge, operational knowledge, apart from just kind of financing the deals. So that really helps us get the advantage where we are able to source deals where market participants sort of know us as operator owners, and we get access to deals firsthand. And just out of experience, we've sorry, just one last thing is we've seen really deals where you come in bilaterally and discuss transactions happen much faster than getting into processes where you are one amongst 30, 40 people. That kind of really derails the process.
No, and that's an excellent point. You bring it, it's not just an investment for you. You bring a value add to the proposition, and that's a wonderful thing. And it's a great way to get your foot in the door in some prime deals. And Divakar, what are you doing nowadays in that area in order to be able to get your hands on some of the prime deals that are out there in the marketplace and discover them?
I think, as Krishna mentioned, right? So it's your network basically. And when you let your network know what your focus is, you get a lot of good references in terms of the deals that are out there. A lot of the times, especially when I advise clients who are already operators, most of the deals come through their own vendors or the board sitting on different boards. And in general, when you're sort of sourcing it by yourself, it's just doing good research and meeting people out there. You get good opportunities. They just show up. So that's what I would say.
Yeah, no, good point. It's kind of like the harder I work, the luckier I get, right? You put yourself
Exactly.
out there, meet a lot of people. And Bobby, you deal with a lot of different family offices. You make investments yourself. What do you find is your secret sauce in finding great investments that help you excel?
Yeah, I think it's everything that Krishna and Divakar actually mentioned. Of course, it's the network, but I would actually add in the nuance around it's the ability to disseminate that network, and it's the analysis of that data, isn't it, really? So if you think about the fact that we all get deal flow, I mean, we see a lot of deal flow, and yes, we do allocate personally, but we also are, as part of our tech platform, we are able to see deal flow, which our clients are actually allocating to because they tell us about it. And they actually sometimes say, what do you think of this? Even though that's not the core proposition behind what we're building as an AI company. But it comes back to that data. So if you have, so my view on this is that you have your network, and then it's the granularity of how you're operating. So if you have a club, and so you have plenty of these clubs or organizations which provide deal flow, and some are very, very good, and the ones in the valley, some are exceptional. If you're able to actually tap into those flows, then as many of those flows as possible are good. You can't analyze them manually, it just takes too long. But then it comes back to what are you doing with that data and how are you assessing it? And whether you do it yourself, i.e. do we do it, or do we actually say, right, we've done some partial distillation and analysis, and then you now do what you want to do. So we're thinking about how do we optimize that as part of our platform, which we're building, which is really around wealth and wealth workflows. So yeah, and I think it's very easy. My last comment is that it's very easy to spend time networking, and it can be dead time because you might think that you're networking in the right spaces, but you're not. And I think you need to have a much more process-driven approach to it, and I think that's the only way that you'll get great deal flow. But you also need to have a reputation out there that actually people will show you something good and you can perform. If you can't perform and you can't get on with it in a timely manner as well, and be decisive, you won't get shown deals. So I think it comes back to that.
Excellent point. Reputation is critical when it comes to investing and getting people to give you prime deals. Now, this next question is going to be a little bit of a fun one, right? Because the other day I'm watching Elon Musk, and of course, he's always primed for putting stuff out there that makes you shake your head. But he had this one mic drop moment where he goes, people really shouldn't be wasting their time squirreling away money, because over the next 20, 30 years, it's not going to make any difference whatsoever. So let's start, I guess, with this one with Divakar. And what are your thoughts regarding Elon Musk's statement? You can go any direction you want with this, but I think if you could tie it back into a multi-asset portfolio thinking, that would be great.
Sure. I mean, yeah, it's tough to be in Elon Musk's shoes, right? He's already worth trillions, right? And there's also you'll also have to look at it from where you are situated as an investor, right? So if you're in the US, access to capital is easy. You show sort of the intellectual property and you get access to capital, right? Whereas look at somebody who's, say, in some place like India or Thailand or someplace like that, well, access to capital is not so easy. So you do have to sort of squirrel away, protect your capital, because in emerging markets, capital sort of helps you gather more capital, right? So I would say it depends where you are, right? What's the basic income levels and what's the basic securities you have as an economy, where you can sort of forget about not earning and things like that, right? So I would still say if you are an investor in the emerging markets where there are a lot of regulatory risks, there's founder risks and all sorts of other risks, right? And there are market inefficiencies also. So you go the traditional way, protect your capital and keep sort of growing it organically as well as inorganically.
Super. Thank you very much. And Bobby, what are your thoughts about this Elon Musk mic drop comment?
Well, when Elon speaks, I think that even if he makes a flippant comment, one has to listen. And he's a great thinker. And that interview, I think it was Peter Diamandis, and he's a great thinker too. I would come back at it from the other perspective, which is, well, the future is really about the next gens, isn't it? And Gen Z, and what are they thinking? So I think you've almost got to go back to them and think, well, what do they feel that they should be allocating to? And what Elon's really talking about, in my opinion, is that there's going to be disruption, isn't there? And we're seeing that right now. So you've got that disruption happening right now. We're seeing in AI. I mean, it's crazy how we're optimizing our business and other businesses that we either partially own or own. And the optimization isn't just at the coding level, but it's clearly across the operational efficiencies. So with robotics and all of that, I think that it's definitely changing. So how do you actually factor that into your portfolio? Then you clearly can't just do nothing. But I think it's about, again, assessing what's happening at that macro level and then allocating in accordance. But also thinking about, well, what are those portfolios likely to look like if you ask your kids? I mean, we've got 3 boys, and so and they're not that young, and they are interested in what their portfolios will look like. And clearly, the crypto topic hasn't come up, and then digital assets generally hasn't come up. But if you ask them, they've all got allocations. So what does that mean for digital assets? And it's certainly not digital gold, because it didn't evidence as digital gold recently, did it? I mean, it's not a hedge at all. But I think that is their mileage in allocating to that type of space, of course, because you've got that sheer wave of money chasing it, which also comes back to that democratization of private markets as well, which is what they're also looking at from a Gen Z and next gen perspective. So,
no, thank you, Bobby. And Krishna, I'd really be interested in your thoughts on this. And yeah, let's have some fun with it.
Yeah, well, when I heard when you made the statement, I started thinking about it very spiritually, and I like to think about things that way. So yes, of course, at the end, you don't get anything and you don't take away anything. So yes, nothing is going to matter. But I think if we take a few steps back and just think rationally about it, life is going to continue. People are not going to go in a direction that's going to be completely sans materiality. So yes, things will be very different. I think about how 25 years ago investing was, and how I was looking at it, and probably even 25 years prior to that, when my ancestors, my parents were looking at it. Times have definitely changed, and probably they're changing at a faster pace now, like both Bobby and Divakar have said. So it will be very different. I cannot even think or imagine how not just portfolio allocation or asset classes, but just how life will be in the next 25 years. And we actually have this conversation every week between me and my wife, in terms of what we have seen and how we have lived our lives is going to be extremely different to how these guys are experiencing life today and how it will be tomorrow. And that's going to change dramatically. And what we think we're going to be doing for them or providing them is very different. So I think over a longer period of time, yes, the activities will continue. They will invest. It'll just be very different. The level of access, the kind of information flow that has changed investing over the last 20 years will probably dramatically change. They may not even worry about these things. It may be decisions that may be taken very robotically, like Bobby was saying. So, but it'll continue. I don't think that anything's going to stop. It will follow a certain process.
Yeah, no, the times they constantly keep changing. You need to move forward with them. I remember when I was in law school, one of the lessons I received was that in the early 1900s, the biggest concern in New York is, what are we going to do with all the horse poop from all the horses that are around New York, right? And little did they know that was the last thing they were going to have to worry about. So we're going to get towards the conclusion of this. I like to think about the multi-asset portfolio thinking. I saw something the other day where Stanford business professor divided their class into groups. They gave them each $5 in 2 hours and said, I'm going to give some kind of credit to the one that comes up with the most money. And one group went and they spent money and bought lemonade, started selling lemonade. And that was the resource they were using, which was a low-level resource for them. Others ignored the $5, sort of a red herring, and just started hiring themselves out or selling out their services to businesses. And that was another good way of looking at it. But as it turned out, the award-winning version of this story was one of the groups went and they sold their time slot to a company to then be able to present in front of a bunch of Stanford business people. And they're the ones that raised the most money. So thinking outside the box is really critical when it comes to multi-asset portfolio thinking. So I think let's go through with everyone. You sort of have free range here to explain exactly what your thoughts are and give me a conclusion on multi-asset portfolio thinking. And we'll start with Bobby on this.
Sure. Understand. Yeah, it's a good point by the way, about the Stanford exercise. And it goes to show, I think, that creative thinking is really what it's about, isn't it? I think that the creatives will have it going forward. I think there'll be an investment in creativity. I think that AI is there and you can interrogate, but I think human beings that can think creatively, that's going to be what I prize, and that's really what we try and assess for when we hire. And we're looking at artists, etc. We want that sort of fluid thinking. So I'd say for me, it really comes back to being aware of what's happening at a macro level. And I've said that a few times, but that's just so profound, and it really needs to be the way forward. Then it comes back to that education, and clearly it depends on who we're talking about as an audience when we're speaking now. But I would also say that it comes back to that longevity of the portfolio. So even touching on what Elon was referring to, I would say that if you look at other people like, I don't know, Dalio or Buffett, what would they say? I mean, they clearly have a completely opposite view to, just don't bother saving. Their view is completely opposite. So I think it comes back to what is that framework, but what is that framework around an IPS and which is or investment policy statement. And I think this is what's relevant to everyone. So it's not for a family office to put forward an IPS. It's not for a fund or whatever. I think everyone should put together their own family IPS. And then they should think about it in the construct of 100 years. So we've been trying to build out on a digital basis, what does your 100-year family look like? And if you start thinking with that timeline, I think that really starts to sharpen your thought processes around allocation and making sure it's truly diversified and you're hedged and you're thinking about paradigm shifts such as the one that we're currently going through, i.e. AI.
Excellent. Divakar, your thoughts and summing things up?
Sure. I think I have some basic principles on how you should manage your multi-asset portfolio, right? See, generally all assets just want to go up, right? So just diversify in a reasonable way. It's good to chase growth. I haven't been successful with the value part of it. So generally chase growth. But there are times when all assets correlate to one, right? So have good hedges, protect your portfolio for the really bad times, and just keep seeking undervalued assets. There are times when you really find assets which are nobody's looking at. Don't write them off. Just keep working at it and create a well diversified portfolio with a growth mindset. I think that generally does well for investors.
Excellent. And Krishna, you're at a disadvantage. You're going third with the summing up here, and
No, not at
a lot
all.
of the good answers have already been taken. So go ahead.
Not at all. No. So I think the entire market has changed, and I was just thinking about it. And I was writing a few points down as to what's really happening. We are seeing dynamics changing. People are not, the economy is not the same. The entrepreneurs are not the same. Today we've got unicorns. You've got young minds who are thinking very, very innovatively, and you give that example, and that's happening in the real world. People are not being limited by what is seemingly their available resources. They're challenging. They're not afraid to take risks. They're going out in the market, and I think Bobby mentioned about diversification not being real, and that also we've seen. But I think with the way I'm seeing this trend, where people are thinking, they're very innovative, they're risk takers, and they're not limited by what they know, but by what they're thinking and by their own vision itself. Diversification also, I think, will change. We've seen enough time about where everybody talks about diversification, and really diversification is generally just leverage to global liquidity as a metric, and more often than not, the moment that liquidity moves, everything, all portfolios move with it, whether it is geographic diversification in the same asset class, etc. So I think that will definitely change. And from an overall perspective, I think my portfolio will always be balanced in terms of having assets that are real assets. I would look at land, and I would look at innovation now as an asset class more than any kind of tech, but really innovation, which will change, I think, investing going forward.
Excellent point. As far as sometimes diversification being illusory. When you make some of these investments, you never know what's going to happen. It reminds me of one company that I owned. They're a software company, and they just couldn't get their act together, couldn't start selling the software. And then they started looking at their patents, and they turned from a software company into a patent litigation company pretty quickly. And I didn't see that coming out of the gate. So I'll just wrap up quickly here. We need to be clearly, you don't want to put all your eggs in one basket. Clearly, you want to be open-minded and thinking outside the box, particularly with how fast the economy and technology is moving nowadays. You always got to be concerned about your reputation. Your reputation, you only have one reputation. It can be undermined in an instant. It takes decades to build. It can be undermined in an instant. That's very important. And your connections, plumb your connections to try to look and find for the asset portfolio allocation that makes sense to you. Because at the end of the day, you know what your risk tolerance is, and you know what your is going to allow you to invest, make money, and also sleep well at night. So thank you, everybody, for being part of this panel. Some amazing panelists. Bobby, Divakar, Krishna, thank you so much for being with us here. And with that, I turn it back over.
Thank you.
Larry.
Thank you.
And let me bring everybody on spotlight once again. Okay, where is our last panelist? Krishna. Okay, Krishna is here, Divakar is here, Larry is here.
Bobby. You need Bobby. BCV.
Oh yeah, BCV. Thank you very much once again for that entire conversation. Multi-asset portfolio. Yes, there was the conversation about thinking out of the box, and that reminded me of something. So I'll come to that also. But thanks for the insights, and I think that was a great conclusion to our Capital Conclave. From tomorrow, we begin our R&D symposium. So a fitting conclusion. The conversations were very apt and kind of wraps up the whole Capital Conclave in a fantastic manner. So thank you very much. And let me tell the story which I remembered about the thinking outside the box. So this was one of the coaching conversations we were having, and we were talking about thinking outside the box. And